Hi, we are the Three Gigs, Three Guys in Glasses. I am Craig, and I play a CM owner role in our discussions,
I'm Jim, and I play a general contractor role in these discussions.
And I'm Paul, and I'm the lowly subcontractor in our discussions.
which is to say the actual entity that builds everything that we make a profit off of.
Including being the bank,
Yeah.
which
There
I
you
think which might be actually somewhat relevant to our discussion today, I
And
understand.
hopefully that's the last time I say anything supportive of him or what he does for a living. So today, I thought bonds and insurance. I run into owners and even general contractors who, project managers, project engineers, who are a little confused about a bond versus insurance. And I thought we could talk about that just as a definition. I'll take the first stab. Bonds versus insurance. A bond is a assurance that an action will take place, and that assurance is backed up by money, by financial sum. Whereas insurance is in place to protect against losses. And that definition probably doesn't help you if you don't know what either of those are, but hopefully that's what we'll get into.
Yep.
So,
But they're kind of both issued by insurance companies.
they are.
Right.
And a lot of insurance companies create surety companies with a different name sometimes, but they're owned by big insurance companies.
But that word surety really is kind of what I think defines a bond.
Mm-hmm.
A bond is a insurance policy that gives an owner surety that, they feel confident and sure that no matter what, either my contractor or the bonding company behind them will complete my job.
Right.
And the money doesn't have to come directly from the surety for that to happen. The surety is going to assure the owner or whoever purchased the bond that it will happen in one way or the other.
So let's talk
as
about
opposed
that.
to an insurance policy that is an instrument that is ensuring that when you suffer a loss, this policy will pay under the terms of the policy.
Right.
Yeah.
But when you get a bond, who gets a bond, and what are the elements of the bond? I've always understood and seen a bond is three parties, whereas insurance is two parties.
Mm-hmm.
So, and they consider the surety company a party.
Okay. There you go.
The contractor a party, and then the owner or whoever's going to benefit from that assurance as a party.
Because a general policy in all the companies I've worked for is that, let's just say you were doing a $25 million project, and your key trades, mechanical, electrical, plumbing, maybe concrete, they were over $500,000 contracts. Maybe they're $1 million, $2 million. 10% of 25 million might be $2.5 million. So your mechanical, HVAC and plumbing contractor might be $2.5 million, and that is a pretty big risk if they were to fail. So as a general, we would get a bond on a subcontractor just to protect us in the event during the course of that.
And the bond is going to benefit you.
Surety to the general contractor.
It doesn't name me.
Doesn't name the owner.
Okay.
No. Yeah.
But when you go out and get a bid bond, you'd mention.
We might want to kind of separate this out.
Yeah.
First of all, there are three basic kinds of bonds in the construction industry, right? There's a bid bond for dealing in the public works arena. I don't know that you ever would require a bid bond on a private job.
Private job.
Yeah, probably not. So
there's no reason not to.
No, you could.
Other than it costs money, and most
and the owner doesn't
don't
want to have to pick that up, right? And so first and foremost, the owner or whoever has asked for the bond is willing to pay for the bond typically, right? So I mean, it's always something that flows up. So the first kind of bond would be a bid bond, and then the next would be a payment bond, and then a performance bond. Many times the payment and performance bond get wrapped together even in our vernacular, and we'll just call it a payment and performance bond. Two different instruments, really. So let me talk about the bid bond,
Right.
and then you guys can kind of pick up on the other ones. And,
Right.
and I'll give an example of how, how it might be a little different than insurance. The bid bond is something that an owner would require of any contractor that is bidding on their work. And it is to be purchased in the amount of 10% of the purchase price or of the bid price. So if I have a project that's $1 million, I have to get a bid bond for $100,000. And what that says is that if I bail out after bid day, then that owner that I bid to can charge me $100,000. And if I am not willing to pay for it, now I'm going to give them either a bond, or I can give them cash, or I can give them a cashier's check, or a bond. Yeah, so those are basically the two. But if for whatever reason I end up bailing, they can charge me $100,000.
Yeah.
So if I gave them a cashier's check, they're just going to cash the check. If I gave them a bond, then they're going to reach out to the surety and they're going to say, "Hey, this guy is a deadbeat, pay up."
And then what does the surety company do?
The surety company comes to me, always in a bond. That's the deal.
Yeah.
The
Right.
person that gets the bond is really the one, because when I struck an agreement with this surety company through an agent, they made me put up a personal guarantee that they were not going to suffer any loss, in essence, and that they will come after every asset that I have: my houses, my land, my toys, my company,
Your
my
6
equipment.
motorhomes?
Yeah, absolutely. And it doesn't matter if I'm a corporation or not, because I have to create a personal guarantee for that.
Yeah.
And so let's say that I chose not to go and do that work, then the bonding company then calls me and says, "Hey, you're on the hook for $100,000, pay up. If you don't pay up, I will, and then I'm going to come after you."
Yeah. And the owners in that case are public works entities, and your bid comes in at a certain time and 10 people bid on that project. They open them all up right then, and the low bidder is announced. And in the event somebody says, "Well, geez, it was a $1 million job, but the next 4 bidders after me, I'm the low bidder at $1 million, are at $2 million.
$2 million, yeah.
And then you realize something's wrong.
Yeah.
I messed up.
Right.
So you could actually choose, I'm going to pay 100 versus $1 million because if I do really do this and those guys know what they're doing, then I missed something.
And contractors are reticent to absorb that. It's a little bit like playing the stock market or gambling in a way, because they know that that's going to be a loss, but then something in our mind clicks and says, "But if I go out there and perform well, then I can make that up, because look, here's something in the bid."
Always the optimist.
Yeah. Always.
Yeah.
So this has taken more than a few contractors down over time. And so many times when the bonding company, says, "Yes, you are going to be responsible for this," because the contractor, if they did come in low and they want to bail, they're going to hope that the owner will say, "Oh, you're forgiven. Don't worry about it."
Okay, performance or payment bonds. What those? So in a bid bond, if I'm the city of Portland, and you're a general contractor, he's going to give his bid in, and he's going to get a bond.
Yeah, and the bond is accompanying the bid on bid day.
Do you, for bid day, also produce bid bonds that you give to the contractors, or
No,
is it
only
as a sub?
the prime,
No,
only the prime contractor, whoever is bidding directly to the owner.
Okay.
Yeah.
But in terms of performance and payment bonds,
It's whoever is asked for one has to provide one.
So if it's a public bid, like we were describing, you would have to provide a performance and payment bond as part of your contract. And then I, as a general, because I've given you that
you
bond,
give me a bond.
my bonding company says, we'd like you to reinsure us by having some of your key larger trades that have big exposure provide a performance and payment bond to you, so that we've got a little protection underneath the blanket.
Or if a subcontractor shows up and they're not all that well known, or their reputation is a little sketchy, or their financials in some kind of a qualification process didn't look that well, then you say, make them bond.
Okay. There is a lot to unpack here.
Yeah.
But
Yeah.
we're
This just
going to unpack that.
became a little more than a definition, I guess.
No, this is fine, but
Yeah.
it's touching all of the icebergs. We're going to do a discussion about that, but every one of these things has some real nuance that is important to know if you're going to function in our business and industry. So we've got bid bonds. Predominantly, you're the producer of them. You give them to me. That's assurance to me. You have payment and performance bonds, which are probably, I'm guessing, what they sound like. One is
just
promising that everybody gets paid, and the other is promising everybody completes the work
per the
contract,
documents,
right?
Yeah.
And again, there's some nuance there, a lot of what ifs, some questions you might have. Feel free to put questions in the comment if you want. Okay, so there's a bond, and then there's insurance. Do I get insurance that you complete the job?
Insurance is a different vehicle. It's more of protection. It's more if I'm building this and I build it incorrectly and it fails, insurance will protect the owner for the failure.
Yeah.
For the losses.
And if during the course of construction I tear something up, break something, dig into something, my liability insurance is going to cover that. Somebody gets hurt on the project, I'm going to have workers' compensation and liability insurance for that. I have equipment insurance. Insurance is just like anybody's car insurance or homeowner's insurance. When you suffer a loss, you claim against the insurance company, and they will pay per the terms of that insurance policy.
So you're going to have insurance for your company and your people and your equipment, and you're going to have insurance, and that's rolled into.
And you're going to have insurance,
and I'm going to have insurance.
Yeah,
right.
You're going to typically provide builder's risk, which is fire, flood, theft, in some cases. What other? Catastrophic.
It's
failure.
Basically it's property insurance.
Property insurance.
So if you've got a house, or if you own a house, you have property insurance. If you've got a loan, the bank will make you have property insurance. If you're building something, there's nothing there. If you go to a typical permanent property insurance company and say, I want to get property insurance on this building that I haven't built yet, they'll say, no, we don't do that. Yeah. Talk to us after it's built, right? So what you're talking about is a policy that I can get that insures all of the material and labor as it gets put in place and as I buy it, right? So for it to move off of you guys, you have to bill me for it, and I have to pay you for it. And now it's not really on your insurance. Now it's on my insurance.
But you make us keep our insurance in place for several months, year, more sometimes, after the project is complete.
Right.
Completed operations. Yeah.
Completed operations.
So that's just another insurance for you,
right?
In case something does go horribly wrong in the project.
Okay, so that's our definition for bonds versus insurance. They are very different instruments, and you use them for very different reasons. Check out our discussion about this, and I think we've got no more things of importance to say about these two things, unless you got last
I think it's pretty good for a definition, but there's a lot of nuances we'll talk about later in a discussion. So.
Okay, we are Three Guys in Glasses. This has been our definition talk about bonds and insurance. If you like this, give us a thumbs up. If you didn't like it, give us a thumbs up, and subscribe. Thank you.
All right.
Goodbye.
Thanks.